morning, everybody. It's Hammer. Today is Wednesday, February 7th, 2024. I, of course, with Originator Success here at the Daily Rate Lock Conversation, your daily rate update, the only place on the web where you guys get to join me and be part of the conversation. Remember, you can join me live each and every day, 9:30 a.m. Eastern time. If you're watching on the replay, don't forget, give us a hashtag replay in the comments, whether you're watching on Facebook or on YouTube. Either way, don't forget to smash that like button, tag and hello friends, share us in the group. If you're on YouTube, click that subscribe button and go ahead and give us the thumbs up, all that good stuff. So anyway, what do we got going on this morning? Well, rate sheets today should be better than yesterday, continuing to improve from Monday's worst levels. Let me show you some fancy charts. We'll talk about why. So if we take a look here, these are mortgage-backed securities. I'm currently monitoring the 5.5 coupon. You can monitor the 5.5, the 6.0. It doesn't really matter. They're going to move pretty much in lockstep. You're not going to see one move in the opposite direction of the other. Anyway, this morning we're down about 8 basis points to start the day, which is negative, but yet rate sheets are going to be better. Why is that? Well, it has to do with yesterday. You can see here, we had a really nice improvement through the day. When pricing came out, we were right around 99.56. We ended the day around 99.67. That's about where we're at this morning. So even though it's funny because it shows us down 8 basis points, but we ended the day yesterday right around that same level, 99.67. That actually would put us flat, but I don't know. I don't get it sometimes when they come out with these, but I don't know what they're using for the base level on the open here, but we're kind of flat on the day here, but it's still a lot of improvement. As you can see here, when you watch this pretty little line, when this line goes up, that means your rate sheets are going to improve a little bit. And that's what we're looking at this morning. As far as the other good stuff here, reprice risk on the day is low. It's not likely that we see too big of a move today. You can see that our overall trend, if we look at these Japanese candlesticks, we came all the way up after the Fed meeting. We peaked right here. We saw that labor market data cause a big red candlestick right here, a loss on the day. And then over here on Monday, we had another loss right down here, which we can see. So we're showing nice improvement since then. 10-year treasury yield, 4.12. Would have liked to have seen that continue to go down a little bit. If you take a look, we capped out at 4.16 on Monday. Yesterday, we were down to 4.10. It's up a little bit this morning from there. You could see that we are right on this purple line. In fact, let's go ahead and move this to 1 day, and you can see it even more clearly. Take a look here. Yesterday, it did rest on the 200-day moving average. Arguably, this is now a technical resistance level. What that means is that it's going to struggle to see improvement past that level, but I don't believe that. I think we're gonna actually see that. I think we could actually see that today. So I'm not overly concerned about it. I'm not gonna bet the farm on it. But when you do see this, you do see that it is a level we want to pay attention to. Traders are struggling to see that the 10-year should be below that. We might get some help on that this afternoon when we get the 10-year treasury auction. Now, the 10-year treasury auction, it is a record 10-year bond sale. So this is going to happen at 1 p.m. Eastern today. At 1 p.m. Eastern, we're going to see, where's my happy? It doesn't have, all right, well, sorry, I was going to make this smaller, but anyway, 1 p.m. Eastern today, we're going to see that that record 42 billion issued 10-year treasury bond yield. So we're going to wait and see how that goes. But all right, let's take a break. Let's go ahead and say hi to the live folks here this morning. I was kind of playing with my format a little bit to see about the replay, but let's see who we got here live this morning and say hello. We got Rob Stewart, good morning, sir. Cindy Pulliam, great to see you here. Scott Menser, hello, my friend. Nicole Semerad, Ron Siegel, great to see both of you as well. Sean Segaloff, good to see you, sir. Mike Tebow, Michael McAllister, what's going on? Good to see you as well, even though you don't have to worry about rates, but still good to see you. All right, so lock advice for the day is cautiously float. Bonds are still showing some positive signs of recovery, even though we're down a little bit on the day. We're not going to see any real improvements, though, until next week's CPI data. But we do want to pay attention this afternoon, that 10-year treasury auction. We want to see how big is the demand. You know, our market's snapping up this record supply, 42 billion. That could actually push things down a little bit. Even if it does, I'm not in a hurry to lock yet. I know that rates not quite as good as where they were. Let's go ahead and take a look together. We'll look at the Mortgage News Daily here and zoom in on this. And in fact, here, let me just, what I'm going to do is let's go ahead and adjust this to about this big and put it right here. And I'm going to join it next to it. All right. So let's go ahead and pull this over a little bit. Okay. So looking at mortgage-backed security, or I'm sorry, looking at Mortgage News Daily as a reference point. We had pushed up to that 6.9 area again, almost 7. We pushed over 7 on Monday. Yesterday, we came back down 6.96. This morning, we're going to be right around that same level. So it's right in that same realm. It's really not anything to get too shaken up about. Now, that's easy for me to say. I know when you're pricing out a $400,000 or a $500,000 loan, and a half a point in in pricing swing can be a big deal. So don't get me wrong, it's definitely there, but I do think we'll see some more recovery today. Like I said, we're down right now at the moment. The 10-year treasury at 4.12, mortgage-backed securities down about 9 basis points. I think we've got a pretty good shot of seeing that improve. And if we do get a strong reaction to that 10-year treasury bond auction this afternoon, that's going to be good. That'll help rates improve through the afternoon a little bit. So rates are not likely to move much higher from here is my outlook, although we aren't likely to see any significant improvement until next week's CPI numbers. I wanted to talk to you about next week's CPI numbers, though. Something that I am aware of here. Good morning, Sheila. Good morning, Brandy. So here we go. Updated seasonal factors to be introduced February 9th, 2024. So this kind of creeps me out a little bit. One of the things that bit us in the ass with that labor market data on Friday were the changes in the way that they came up with the adjustments. And many of us have talked about how those adjustments are actually what gave such a wonderful job market reading rather than actual job market conditions. I'm wondering what this CPI change here is going to be, and I'm trying to find out some information about it in the meantime. Each year, with the release of the January CPI, seasonal adjustment factors are recalculated to reflect price movements from the just completed calendar year. This routine annual recalculation may result in revisions to seasonally adjusted indexes for the previous 5 years. Recalculated seasonally adjusted indexes, as well as recalculated seasonal adjustment factors for the period 2019 through December 2023, will be made available on Friday, February 9th. The revised indexes and seasonal factors will be available on this page. So it's kind of something I want to be paying attention to. These are changes that we had in the past. We had changes to used cars and trucks methodology November of last year. We had changes to health insurance methodology in August of 2023. We had changes to new vehicle methodology in March, as well as in January. So these are all last year's changes, but that's different than what we're seeing with this seasonal adjustment and the way the factors are in here. So we'll see what this does. But overall, my idea here is that right now, actually, I'll put this back up so I can show you guys here. Right now, markets are very much playing the same game of chicken that we have been. Yesterday, we had Mester, we had Collins, we had Kashari. They were all talking about how the Fed doesn't need to reduce rates 2 to 3 times this year, blah, blah, blah. We knew that was going to be hawkish. You know what? Markets really just ignored that. They were more concerned about what was going on with a little bit of a banking issue with the New York Community Bank and their basically the way that commercial real estate is crumbling. And yet again, another thing caused by our lovely reaction to the pandemic. But I don't want to get too political on it, but that is what is really put some huge devastating losses in real estate, has been driving up rates, which we had to do. And then because people were not going back to work and all these different things that were going on with commercial real estate, it was all driven based on these reactions. So, but in March right now, an 80% expectation the Fed will leave rates unchanged should be higher than that. The Fed is not going to cut rates in March. I don't know anybody that would think that they would. Remember, we at one point last, October, they were looking at maybe June, and we pushed all the way down to March. And that's one of the reasons that rates dropped so dramatically from October's worst levels of last year. Now we're looking at May. And that tends to fluctuate between 35 and 40% of an expectation that the Fed will continue to leave rates unchanged into May. Now, we've got a lot of economic data between now and then. And what we're looking for is any kind of signals of economic slowdown, but we haven't seen those. The economy is not slowing down. People are out spending money. And we're looking for labor market data, which, has also, again, coming in strong. So it's not really that likely that we're going to see where the Fed is being forced to do this. What they're going to look at is that inflation number. Of course, the Fed's favored gauge of inflation is the PCE, but they are paying attention to the CPI because it comes out first. And next week's CPI data, it's either going to help us to kind of see rates drop back down, fall back to these 6.7, 6.75 mark, let's say, using Mortgage News Daily as a baseline, right? It's going to bring us back down here. Otherwise, we're going to be spending time right around this high sixes, low sevens area. We're not going to see rates get crazy high from here. They're not going to move significantly higher. I know that any higher is bad higher, right? Everybody wants to take advantage of whatever. But I mean, the reality is that even the best level that we saw for a split second after the Fed meeting, remember the Fed meeting was on the 31st. That's when they came out with everything, the press conference. The best rate sheets were the day after. On the 1st, that was 6 5/8, and now we're up to 6 7/8. So, that's a quarter point. Is it really? That's a quarter point in rate. Yes, I know a quarter point in rate is devastating, blah, blah, blah. I get it. If I had to pay it, I certainly would want to pay it. But when you actually step back and look at this, we're in a really good spot. Rates are going to continue to work their way down. We just got to be patient with that and take a look at that. So that's it, my friends. Ron said that he appreciated that chart yesterday about the Doves and the Hawks on the Fed. Good. Thank you, Ron. Appreciate you, sir. Good morning, Pat Tenney. And, of course, like I said, Sheila and Brandy, great to see you guys here. Derek Bobadilla, I haven't seen you in a while, so great to see you as well. Again, I'm going to try to find out if I can – what are the expectations with any of these seasonal factors and if it's going to really affect what we see for the CPI data next week. I haven't seen anything that would cause any concern yet, but we'll see. Ron says, I bet if we didn't have all the seasonal adjustments, I bet we'd see the economy is slowing. Freight is slowing. Challenger is growing. Real job losses in January. Cost of goods still high. Gas prices increasing. Yeah, Ron, you know what, though? And I will say that services, though, manufacturing, all still chugging along. When you look at what happened with the GDP data, still, they can't really – I won't say they can't manipulate it, but it's much less manipulated with the adjustments. All of that doing well. People are spending money. And I see it in my area that people are out spending money for sure. What do you guys in your backyard? And Sean said, can I resend that chart? And you emailed me the day. Awesome. Sean, I will check with that. And as far as the chart, it was a Reuters chart. I'd have to see if I could pull it up again here. Here we go. Let's see if this was it. Was this it? Yes. And I will post it again. Here is the Doves Hawks chart. There you go. Posted it again for those of you that may want to see it. Just kind of lists out the different members and their stance on things and who they are. And it's important to note, like Michelle Bowman, she's going to be speaking today, but markets are going to ignore her. They know she's super, super hawkish. And she is one of the voting members because she's a governor. I think who else is speaking today? Let me take a look here. I think actually Mortgage News Daily, they had it on here. Let's bear with me. Let me make this smaller so I can, there we are. Barkin, Collins, Bowman, all speaking today, Kugler. So it's a lot of Fed speakers, but market's not too worried about it. Hey, look at that. By the way, while we were sitting here together, enjoying life, we went from -9 to +2 basis points. And there's a little bit of choppiness in trading. I'm sure this will drop negative again, but go positive. Oh, you guys aren't seeing it. Let me make this full screen. Hold on a minute. Boom, 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 boom. There you go. So we are up 2 basis points on the day. Again, that's going to help rate sheets to improve a little bit. No data we really want to worry about. So, all right, my friends. Well, that is it. I sit and read this stuff every day, and I feel like, and then other people ask me to talk about it in other places, and I feel like this is so boring. I talk about this stuff, and everybody knows this. So thank you for coming every day because you remind me that not everybody knows it and that I spend all this time reading. Take a look at this, right? I sit and read. Here we go. Losses turning to gains as NYCB drama reemerges. That's what Matt Graham over at MBS Live is popping up there. That NYCB, that banking stuff, always going to help bonds. That freaks everybody out. So, but I mean, I sit and read all this stuff. You can see all the different tabs I have open and what I'm reading here with Reuters and Bloomberg and the Wall Street Journal and all this. And I kind of read all that every day. And I forget that basically, even though I'm just kind of picking and pulling the good parts and sharing them with you guys, that it is there. So also, since I'm playing with it, here's my new Benchmade knife. What do you guys think? That's my, this is called the Freak. I don't know why they call it the Freak, but it's a fiberglass handle. I like the little splash of red. It matches my Jeep. I like black ceramic blades, and I love Benchmade. This is M4 steel, which is a very hard steel, holds an edge. So anyone else collect pocket knives? I know it's, if you looked up the price of this knife, you would probably think, Hammer, you're so bougie. I like good knives. I do. Oh, Deb Dickinson, let me get you that. I'll go find you and give you the link to put in again. Ms. Pat, have a great hump day as well, my friend. Yeah, be careful showing the knife. Calizuela, outlaw it or tax it. Exactly. Well, good thing I live over on the East Coast, my friend, in Appalachia. And one of the reasons I moved here is we love our freedoms. So, all right, y'all, I'm going to get wrapped up. I'll see you guys tomorrow morning. Same bad time, same bad channel. Bye-bye.